Hi everybody, welcome back to the chapter 4. It has been a while we conducting the video recording and the chapter lecture. So I I noticed you guys are watching a video. Some of you guys, so I appreciate it. Um, so let's keep talk about chapter 4. Chapter 4 is relatively much I cannot say much easier. It's building on what happened to the chapter 3. But mm, chapter 4, partially like 50% of the content is talk about internal control. And then 50% of the content is talk about what is cash. So you will say, wow, I know what is cash, but uh, from a company perspective, cash is more than bills, right? So there's a lot of things that has a high liquidity, and we also consider them as cash. And then we're going to talk about it in the second part of this chapter, the video. So the first part of the video that I'm trying to focus on majorly what is internal control and why do we need internal control. Okay, so without further ado, let's starting our first part of the video. Okay, I'm gonna do the screen share. That way we can see um, the lecture better. Okay. Mm, okay. So as you can see, so chapter 4. I'm just gonna using this way of presenting. Probably that's better. Okay. So chapter 4 is talking about cash, right? So the internal control part A. So we know as a content, there must be some mistakes we're having during the time that we actually recording our transactions, right? So we call that accidental errors in a recording or transaction applying to accounting rules. That's something that is understandable. However, there's something not understandable or a very bad thing to do is a person or employee intentionally trying to deceive another. I don't know what happened. Okay. Oh, okay. That's good. So this is actually the person intentionally deceive another person or for personal gain or to damaging that person, and this actually happen very often in corporate America, right? So and we call this occupational fraud, and it defined as use one's occupation as a convenience for personal enrichment throughout the deliberate misuse and misapplication of employer's resources. And as you already jump ahead to see, uh, so how did I go to? So the next slide we want to talk about is the famous accounting fraud, which is Enron and WorldCom, right? And Enron, as we know, is actually biggest fraud in American corporate history. And then I suggest you just go to the YouTube and watch some kind of short-term video, short video, and I will suggest some and post in the uh, on the Blackboard as well. So and then it's actually essentially Enron's fraud. It's actually accounting fraud. Hence, that it's very important for us to understand. Um, how did they commit such fraud? It's just simply avoiding reporting billions in debt and losses. So you will ask me, say, well, it sounds like it's easy to catch, but when the company grow that big and that complex, cover that many industries, a lot of people doesn't know anything about what's really going on with the company. Hence, the executive has a lot of opportunities that to conducting the fraud by avoiding reporting the losses and reporting the borrowings. At the same time, another fraud is a word come, and then from an accounting perspective, they misclassified a lot of expenditures, hence that they overstated their asset and profitability. In total, it's about 11 billion. So as we learned from beginning, expenditure, right, in the first three chapters is actually reducing net income, right? Hence, if you avoiding to reporting it, so what's gonna happen is your profitability gonna go up, right? And if you don't spending expenditures, hence that your asset is going to be overstated as well. Okay, so just link with what we have already learned. Okay, and next. So, and then this, all these scandals actually we wanted to talk about is the most important thing is actually managers are the ones this biggest scandal are responsible. And the managers here that we talk about is the CEO, CFOs, right? And why are they having such powerful and such powerful hand to cover such big fraud? Is because managers are so trusted with the whole the resource of the companies was given to, right, by lenders and the stockholders. And the managers are trusted to be a caretaker or a steward to control and use the company's assets. And then, however, some executives uh, use this trust, use this occupational convenience to shirk their own personal gain to wealthy themselves instead of wealthy the stakeholders or stockholders. Um, so their ethical responsibility, they are shirking their fiduciary duty as a manager, and by misuse or misreport company's fund. Okay, and then so now we wanted to theoretically teach you about what is fraud. I'm sure some of you already, if you're a business major, you have already heard about this. To be conducting a fraud, we call the fraud triangle. The first thing that you want to commit a fraud, not you want to. I mean, if there's a fraud, there must be opportunity presented, right? Without opportunity, there's no way you have a event or certain things you can manipulating or can steal from, right? And second thing is you got to have a motivation, such as you just lose a lot of money, right? Or your daughter or sons need to go to expensive college, or your mom and dad need you to refinance their mortgages, all these kind of personal related or non-personal related, or you have a second business that business is dying. So we talk economic fraud here. So the motivation is always money or greed, right? And I didn't talk about greed. I'm sure those Enron executive who doesn't have anything there that I just described, but they still commit fraud, is because there's a limitless the greed that we as a human that we all have, but they are much, much, much worse than average American. And then the third thing is actually very important, and that's where the ethical education comes in. That once people might present it with the opportunity, and they all maybe have a motivation, right, to commit a fraud, but because he or she cannot rationalize her own or her action or his action, this fraud does not uh, is not able to commit either. The rationalization means that the person can justify the fraud behavior or stealing behavior or cheating behavior. So in summary, opportunity is that it means the situation allowed the fraud to all happen, and motivation means that someone feels the need to commit the fraud and such as need for money. And rationality is a justification of the deceptive act by committing the fraud. Okay. Since there's a such big scandal, accounting scandal, corporate America scandal that hurts thousands of people's pension fund and lay off thousands company employee, At the same time, it's actually damaging the confidence in public accountants, because the error on the fraud can go that far is because there's a collusion between the executive of Enron and Arthur Andersen. At that time, it's the fifth biggest public accounting firm. They audited Enron. So there's a collision between them, then that's why their financial statement is outrageously misreported and didn't detect it for years. Hence, such failure in public confidence motivates Congress to pass the Sarbanes-Oxley Act in 2000. Okay, and this act changed accounting or financial reporting as we know. Among other stipulations, Sarbanes-Oxley set forth a variety of guidelines to guide how the auditors and client relation should be, and additional internal controls, section 404. And we will talk about details, what is the internal control. And in particular requires the company's management and auditor to document and assess effectiveness of a company's internal control on a yearly basis. Okay, so this act, of course, is passed in 2002, which is the year of the Enron collapse, I think Enron collapse in early 2000, and it's also this act also known as Public Company Accounting Reform Investor Protection Act. Okay. And it applies to all companies that are required to file financial statement with the SEC. Basically, all public company applies this rule, no matter you are 500 Fortune or you are small public company. Okay. So specifically in Sarbanes-Oxley, there's following points that is needed to elaborate a little bit more. First of all, they establish a board called Oversight Board. This board, its name is the PCAOB, Public Company Accounting Oversight Board. Like I said, this Enron and WorldCom scandal actually hurt the most. What the hurt, of course, is the event itself, the victims. At the same time, it hurts confidence in public accounting, meaning that no one gonna believe auditor is actually telling the truth to protecting stockholders anymore. So auditors, people start believing auditors is a collision, is friends with executive, not offer fair opinion about whether the financial statements is stated correctly. Okay, hence that to re-establish the confidence in public accounting, Sarbanes-Oxley saying that, okay, let's form a board called a PCAOB board that has also authorization to establish standards related to auditing and quality control and ethics and what is independence and all other activity relating to preparing audited financial statements. Okay. And then the second thing that this act did a great job is corporate executive accountability bring to the agenda. Before, corporate executive does not need to be personally attest the internal control strength of the company, but because this is scandal and Sarbanes-Oxley Act, they must personally certify the company's financial statement and financial disclosure are actually true, right? Several financial penalty and possibly imprisonment are consequence of a fraudulent misstatement. So in another word, before Sarbanes-Oxley, if you're conducting fraud in financial reporting, there is no such set rule that we can directly charge you at. But because Sarbanes-Oxley right now, you have already personally testified that the financial statements already prepared under correct GAAP, and then it's a fairly presenting financial status of the company, then that means that you are personally responsible. If there's anything goes wrong or you conducted a fraud behind the scene, then you will be have a severe financial penalty or imprisonment. Okay. I mean, you meant executive, CEO, CFO, C-suites, okay, COO, CAO, all those O's. And at the same time, this Sarbanes-Oxley also said before auditing firms can providing consulting services to the clients, audit clients, such as they not only auditing your book and at the same time they consulting you how to do business, right? And then this means that the auditors understanding your operation and then also give you leeways or loopholes to avoiding certain scrutinization from regulators. Hence that from now on 2002 says no more. You can either you will be their auditors, the company's auditor, or you will be their consultant. You cannot be both. Okay. And the retention for work papers. So before there's not the specific regulations say how many years of that documents that you audited. So the auditing document has an auditing trail, right? Financial statement has a financial trail, like we learned, like journals, trial balances and the financial statements, all those trails, right? Before there's no such rule saying you have to cap them for certain years, and now we wanted you to cap it for 7 years. Okay. At the same time, because there might be unwanted or collision between auditors and executives, hence there's a mandatory auditor rotation. In other words, that auditor's partner who auditing this firm needed to rotate the roles. Say Jie audited Amazon for 5 years already, so Jie cannot be the leader, project leader for this audit anymore, and Jie it should be someone else because they're afraid Jie and the executive have a good relationship, hence that meeting or forgive some kind of misbehavior, misstatements. Okay. And the conflict of interest, another thing is that audit firms are not allowed to audit the public firms. Their CEO or CFO work for the audit firm and participate a company's auditing in preceding years. For example, a lot of public companies executives, they actually coming from auditing background and public accounting background, especially CFOs. So a lot of good firms partners, they actually worked for auditing firm for years, and then they find a good opportunity, they become advisor, and then they become an executive, right? If that's the case, that you have ever involved in the auditing procedure of the company as an auditor, right? And next year you got a job as executive in this company, you're not able to, you have to fire this auditor and then find a new one. Okay. And also the responsibility of hiring the auditor. Auditor means that which company like a KPMG, Ernst and Young, PwC, and Grant Thornton, and what did I miss? Deloitte. Or those are the auditors. I mean, auditor is not human here. What I meant is auditing firm. So who is in charge in the hiring auditing firm? It's actually not executive anymore. It's specifically said by the Sarbanes-Oxley that it has to be auditing committee. So it's a committee. What is a committee? Committee is directors of the firm. Who is director? Directors are stockholders elected people watching over the firm for stockholders, meaning CEO, CFO's boss, almost. Okay, so there is a board, right? Board of directors, and they establish a special board called auditing committee, right? Within this audit committee, they want someone specialized in financial reporting and being able to hire in auditors. Okay. And then the last thing, which is the most important thing of this section, is called internal control. And then it's called a section 404. I believe this called a section 404 is because this is in the act, is in the section 404. Requires that the company's management document and assess effectiveness of all internal control process that could affect financial reporting. Okay. And that the company's auditor express opinion whether the management assess of the effectiveness of internal control is fairly stated. So what does that mean? means two things. First, as a CEO, CFOs, you have to testify saying that I believe my company's internal control procedures are effective. Okay. Second, the auditors who audit your firm also has to testify saying that what you say about the internal control is true. Okay. So then with that being said, so many we have talked about internal control, internal control. Okay, then what is the internal control? Okay, internal control, the purpose called internal is within the firm. Control means procedures. Okay, internal controls procedures attempt to eliminating the opportunity element of the fraud, right? It presents the plans to first of safeguard the company's assets. Second, improve the accuracy and reliability of accounting information. Okay, achieve two things: safeguard the asset, no one can steal it or move it. Second of all is make sure that the financial reporting is truthful and reliable. Okay, so then we're going to talk about what are the components and the responsibility and the limitation of internal control. So component of internal control, we starting with this pyramid. So the biggest thing that we really need understanding is the control environment. What is control environment? Control environment meant the tone at the top. It's basically set the overall ethical tone of the company with respect to internal control. It includes formal policies related to management philosophy, alignment of responsibility, and organizational structures. In other words, how does this company perceive internal control's importance? Whether the company has ethical standard that is written down that people can read and know about, and how is the assignment of responsibility of each person has the partially responsibility about watch people who will cheat, who will steal, and then also have ethical training courses. At the same time, organization structure also say place whether there's ethical officers, right? So it's all about the environment. And the next thing that this component is a risk assessment. Is actually what's a risk assessment? It's meant it's identifying and analyzing internally and externally risk factors that could prevent a company's objective from being achieved. So this is really broad, right? So internally, you wanted to watch out the risk factor associated with frauds, right? With inefficient operation and with mis financial reporting and intransparency. And externally, you want to watch out the risk factors such as your suppliers relationship, your customers relationship, your competitors, and your stockholders and regulators, tax authorities. All those things can present risks to jeopardize your company's survivalship or prosperity, right? Hence, this risk assessment is also part of the internal control component. And then we are going to move on, talk about the control activity. Hence, since we're understanding, we set up the environment and we will assess our related key risks. Then we're going to set up certain activities or policies or procedures to help to ensure that management's directives are being carried out. And this activity including authorizations, reconciliation, separate of duties. And the control activity actually is separate into preventive activity and detective activity. We're going to talk a little in depth later. And last thing is we wanted to make sure everything is monitored, being carried out, right? Continuing monitoring of internal activity and reporting deficiency is required. Monitoring including formal procedure for report control deficiencies. And then throughout all this pyramid, and then we know that the information and communication is the key to make sure all these components are effective, right? Are well research were carried out. Okay, in short, the overall attitude and action of management greatly affect control environment. Risk assessment, including careful consideration of internal and external risk factors. Control activity include a variety of policies and procedures used to protect a company's assets. Okay, monitoring of internal control needs to occur on an ongoing basis. Information and communication depend on the reliability of accounting information system itself. Hence, if you have you want to select accounting information system class, you will understand that this is a very big part of your course is learning how to design a good accounting information system. Okay, then we remember we talk about the control activities actually break down into two big categories. One is a preventive control, such as a separation of duty, right? Fraud is prevented by not allowing same person to be responsible for both controlling the asset and accounting for the asset. In other words, for example, if you are accountant, you are recording the transaction, and your close friend, is actually guarding the checkbook. Oh, that's great. We open a channel of fraud. That means that you can keep recording the financial transactions and also writing yourself a check, right? So hence that to prevent that, we needed to separate the duties, right? Meaning that the controlling of the asset, which is the check meant the cash box, right? The checking account, and accounting who bookkeeping cannot be good friends or cannot has to be different person, not related to each other. Okay, and the second thing is the physical controls, such as asset and accounting records must keep safe and accessible only to authorized personnel. And proper authorization. Fraud is prevented when unauthorized individuals are not allowed to use company's resources, right? Employee management. The company should provide employee appropriate guidance in how to perform their jobs as well as their responsibility for internal control. And e-commerce controls passwords and business should be required to conducting electronic business transaction and firewall and antivirus softwares. And detective control. So we talk about preventive, right? Something that we said before the things happen to prevent things happen. Detective is that something already happened, hence now I want to find out what had happened, okay? First thing is called a reconciliation, which is a big part in terms of cash. We will learn in detail how to do bank and the book reconciliation in terms of cash account, right? And the management should periodically determine whether the amount of physical asset of the company, cash, commission items, agrees with the accounting records, right? So there's something between the bank recorded this much money and you thought you have this much money, that must because something went wrong, right? Something didn't get deposited yet, something didn't get recorded yet. We will talk about it. And the performance review, right? Performance review is actually review. What we talk about performance review is not only the personal performance review, we talk about the company's personal review. Company's performance review. It means that we review what is actually happened and what is expected to happen, right? So, and then there's a difference. Then we wanted to locate why there's a difference, and who needed to do a better job, right? So, and then the last thing, detectively control is why we need audits. Okay, an auditor who are not your friend, are independent from the company, is to hire to assess the internal control procedures, the strongness, right, strengths, and to detect any deficiency or fraudulent behavior of the employee. Okay, and then you will ask me, okay, so who is responsible for setting up internal control, and who is responsible to make sure it's relevant and it's effective? CEO, CFOs, right? CEO, CFOs, they are obligated, or they have a legal obligation to sign a report each year to assessing whether the internal control are adequate. Okay, that's based on Sarbanes-Oxley 202. And the second group of person are responsible is going to be auditors, right? First of all, they have to provide their opinion on the management assessment of internal control over financial report, meaning that if CEO, CFO say, hey, we are good, we have a good control system, and auditor comes in and say, let me look at it. Are they telling me the truth? And then if they're telling you the truth, you're going to issue an opinion and say, yes, their internal control system are good. And second of all is they themselves aside to agree or assess whether CEO, CFO said is right. They themselves need to providing an opinion on company's internal control over financial reporting. For example, the public company also public auditing firm also need to say that, yes, in my opinion, they have a good control system. And also they say, yes, we agree with David, who is executive of ABC firm, a testament of that their internal control system is strong. Okay. With that being said, there's so many policies and structures involved with the internal control system, but there also has a limitation. Okay, an effective internal control system cannot turn a bad person to a good one, right? You can only do so much preventively and detectively, but if you had a bad seed, you were not able to turn that bad seed to a good seed. That's the first thing. Second thing is internal control systems are essentially susceptible to collusion. Collusion means two or more people are acting together in a circumvent internal control, right? So basically, you and your friend or your partners are trying to, circumvent the internal control mechanism. Then that could be a problem. And third one is top level employee who can override internal control procedure have opportunity to commit the fraud. Normally I believe, okay, the collusion of two employees can cause such damage is actually very limited. What the most dangerous and risky things that could jeopardize internal control strength is the executives, because those people knows the company almost like most important information, doing most important decisions, and they often override internal control procedures because even employee who are working on a subordinate employee understanding what they are doing, but they might afraid of them because they're afraid losing their job and they don't want to say anything, right? So that's why I think the topic of the employee are very important to a company. And the effective internal control and ethical employee alone cannot ensure success or even survival of the business. In other words, even you have a very, very good internal control system, due to the competition of the market, due to the economic environment, it's really hard to say that your company is still going to be survived, right? But without the internal control system, your company definitely not able to survive. Okay. So let's do a concept check. Okay, everyone in the company has an impact on the operation and effectiveness of internal control, but who must take a final responsibility? B, right? Top executive, because they have to personally testify the effectiveness of the internal control system. Okay, so next section, we're going to talk about cash. Okay, I see you in next video. Thank you.